My next guest agrees that the Fed has no reason to cut now, but says that conversation will be alive and well if the unemployment rate rises above 4%, and we are oh so close. Let's bring in Peter Boockvar. He's Chief Investment Officer at Bleakley Financial Group and a CNBC contributor. Welcome to you.
Thanks, Kelly.
Anything jump out to you from what you just heard in particular?
It's clearly a wait-and-see, play-it-by-ear mode that they're in. I think they're obviously leaning towards cutting. I think they want to take sort of the edge off the current level of the Fed funds rate. They're just looking for a reason to do so, and in their eyes, they haven't found it yet.
I think it's interesting that 10 years only at 440 as we talk about all this. Are you surprised the way markets have reacted? Because the Fed officials are clearly signaling, wait, we need to wait and see a little bit more now, kind of trying to push back that timeline.
Well, I think the markets are hoping that the momentum to cut will build as the year progresses. Particularly, the ECB is going to cut in June. The Bank of England seemingly wants to cut. Bank of Canada may do so again. So I think there's sort of a growing momentum that this is the thing to do and that the Fed will follow. But there's a lot of conflicting, complicating stories that are happening here. You have the unemployment rate that is at a 2.5-year high, even though on an absolute historical basis, it's still pretty low. But we see what's going on with commodity prices.
I was just going to ask.
I mean, can any self-respecting central banker want to cut rates when gold's at an all-time record high if you perceive gold as money? Now,
we're going to debate gold, bull, bear, a little bit later in the show. So what's your spin on that? Well, it's interesting to me to watch gold and copper both at all-time highs.
Aluminum at a 2-year high. The industrial raw material index from the CRB is at the highest level in a year. So it is somewhat broad-based, at least on the industrial metal side. Silver also joining the party here. Now, there's no doubt that central banks have been massive buyers of gold, but they're doing that for a reason. They're doing that because they don't want to own as many dollars via U.S. treasuries. So the Fed needs to pay attention to the price of gold, because if they get too aggressive at some point with rate cuts, well, that's going to directly impact the dollar. If you start to weaken the dollar because of what you're doing with monetary policy, that can import inflation. You can see oil prices then rise. Then they're really kind of stuck. So there's no easy path here.
Does it tell you that markets, even though the Fed's trying to kind of push this timeline out, that markets basically are anticipating a dovish outcome? You know,
I think markets have been front-running the easing of monetary policy for the last year plus.
That's generous, or forever, basically.
Yes,
yeah.
True.
No, but so what consequence does that tell you? Do they need to come out more aggressively against it and say, no, you're off to the race? Or does the market itself think the data is going to be more disinflationary in the back half? Because here's the last line from his, obviously he also gave a speech this morning, and he referenced this, but he said, you know, what do I mean by good data? What grade do I need to give future inflation reports? Let's say I look forward to the day when I don't have to go out 2 or 3 decimal places in the monthly inflation data to find the good news. He wants it consistently below 0.3, basically.
Right. Well, you said a very important word, consistently. Because the Fed right now is just trying to play the trajectory of inflation and saying it's coming our way. If we can just get a 2 handle on CPI, we're going to be okay to cut. But keeping it consistently low is sort of the next battle that is yet to be fought.
And I guess what I'm trying to say is it's weird to me that commodity prices seem to be telling us that they take the Fed at their word that it's all going to come down and these rate cuts are going to happen. You'd think that markets would push the other way and say, no way. It's not going to be as easy as you think, but if that were the case, wouldn't we see rates backing up and commodity prices selling off?
So I think the long end is believing that inflation will continue to moderate. The rise in commodity prices are saying, hey, not so fast. This is a much more complicated situation than you think. It's not, okay, the economy slows, inflation just magically gets to 2%. The Fed cuts rates, we all declare victory, and everything is okay. The commodity move here, I think, needs to be focused on, and as I said, is really going to muddy up the Fed's job here.